In a widely anticipated move, the Reserve Bank of India cut the repo rate by 25 basis points, bringing it down to 6%. This marks the second consecutive rate cut by the central bank this year. But while the rate cuts were on the expected lines, it was the RBI's revised GDP forecast for financial year 26, trimmed from 6.7 to 6.5, that sent shockwaves across the markets. The downgrade signals rising worries over global trade tensions, slowing exports, and weakening domestic momentum, domestic consumption. So, why has the RBI cut rates again? The primary reason is to support economic growth in an environment that's becoming increasingly uncertain. Global trade tensions have intensified dramatically, with the United States slapping a 26% tariffs on Indian goods and an eye-popping 104% tariffs on select Chinese imports. Such protectionist moves risk triggering a full-blown trade war, slowing global growth, impacting India's exports, and tightening liquidity conditions worldwide. Against this backdrop, the RBI's rate cut aims to inject more liquidity, lower borrowing costs, and keep the domestic economy on a recovery path. But the rate cut comes with its own set of challenges. Lower interest rates are good news for borrowers. Home loans, car loans, and business loans could get cheaper. However, it is a double-edged sword. Fixed deposit returns, FD returns, and other saving instruments could see further decline. Who will it impact? Impacting savers and retirees. More importantly, the RBI's downgrade revision of GDP growth suggests that consumption and investment trends, through improving, are still fragile. They're improving, but they're still fragile. At a macro level, the RBI highlighted some positives. Manufacturing is reviving, urban consumption is slowly picking up, and business sentiment remain reasonably strong. But the elephant in the room is global uncertainty. Rising tariffs means India's exports competitiveness could take a hit. Sectors linked to global trade like IT, auto components, textile, metal, and pharmaceuticals are likely to feel the pressure. Additionally, if global growth slows down, it could weigh on the commodity prices and remittances, both of which are vital for India's economy. For individuals like you and me, the immediate impact will be mixed. Borrowers may cheer lower EMIs, but investors chasing safe returns will feel the pinch. Market-linked investments are likely to stay volatile, especially as foreign investors react to global developments, global news. The stock market's sharp reaction, with Sensex falling over 400 points post RBI's announcement, reflect these underlying worries, all the worries that I have told you. At a larger level, this move reflects the RBI's balancing act. On one hand, it wants to support growth and ease financial conditions. On the other hand, it remains cautious about rising inflation risks, currency volatility, and external shocks. The coming months will test the fine balance as India navigates both domestic vulnerabilities and global headwinds. In short, while the RBI has done what it could, cut rates to boost growth, the bigger battle lies beyond its control: trade wars, geopolitical risks, and global shutdown. It will continue to dominate India's economic outlook. The road ahead looks bumpy, and both policymakers and investors will need to stay nimble.